Like we're up and running. Welcome in, everybody. Thank you guys all so much for joining us today. I'm Tom Anderson with Hendricks Wealth and Estate Management, and I'm just really glad you're all here today. Um, Today, we're going to be talking about 401ks, which, let's be honest, most of us signed up for at some point, probably picked some generic options that they gave us, and pretty much never thought about them again. Sound familiar? You're definitely not alone. The good news is that even small changes to how you manage your 401k can end up having a massive impact on where you end up in retirement. And that's exactly what we're going to cover today. The 7 most common mistakes people make, and more importantly, how to fix them. Keep it moving, so let's dive on in. Why does any of this matter? It matters because the 401k is the primary retirement savings vehicle for almost all working Americans. It's not glamorous, doesn't make headlines, but it can quietly be one of the most powerful financial tools that you have access to. The problem is that most people treat it like a set it and forget it crock pot recipe. Works great for chili, not so much for retirement planning. Here's the thing. The decisions that you make inside your 401k today don't just affect you a little bit. Because of compounding, small mistakes early on can cost you tens, hundreds of thousands of dollars by the time that you retire. Not even exaggerating when I say that. So today, we're going to shine some light on the 7 mistakes we see most often. Some of these might even surprise you. Others might make you want to log into your account the second this webinar ends. Really, that's the goal. Let's go through them one by one. The first one, mistake number 1, contributing the wrong amount. Sounds almost too simple, right? Just put in more money. But the mistake here can be more nuanced than that, and it's one that we see constantly. The most common version of this is that somebody sets their contribution rate 5 or 10 years ago and had never touched it since. Maybe it was 3%, maybe it was 6%. And look, life gets busy, but here's the problem. Your income has probably grown since then. Your lifestyle has probably grown, and your retirement needs probably also grown. Your contribution rate still sitting right where you left it. Even more common, people contribute just enough to get the employer match, which is a great instinct, but then they stop there. For most people, that match threshold can be somewhere right around 3 to 6%. And of course, this free money is always good, but that alone usually isn't enough to fund the retirement that you actually want. The rule of thumb that a lot of planners like us use is that ideally you want to be saving somewhere between 10 to 15% of your income, including that employer match, to be on track towards your retirement. A lot of people might hear that number and think it sounds impossible, but you don't have to get there overnight. The next time you get a raise, before that extra money works its way into your spending habits, redirect some of it towards that contribution rate. Even if you're bumping from 3 to 6 or 6 to 8 or 8 to 10, those small bumps can make a meaningful difference over time. The goal really is just to be intentional about it, because if you're not, inertia is going to win. Take a look where you are today. Mistake number 2, and this one genuinely can make us wince when we see it, is just leaving free money on the table by not capturing that full employer match. I'll just say it plainly. Not contributing enough to get your full employer match can be one of the single most expensive and easy to fix financial mistakes that most people make. It's not a small deal. Here's a quick example. Say your employer matches 50 cents for every dollar you put in, up to 6% of your salary. Now, if you make $100,000 a year and you're only contributing 4%, you might be leaving $2,000 on the table every single year in free money that your employer is handing you, and you're saying no to it. Over 20 years, with reasonable market growth, that unclaimed match could grow to well over $150,000 or more. That's a real number. Now, some plans have a vesting schedule, meaning that you have to stay with the company for a certain period of time before that match is truly yours. But Of course, that's worth understanding, but in most cases, it can still make sense to contribute the full match no matter what, even if you're planning to leave. If you're not sure what your employer match formula is, look it up today. Probably in your plan documents, and if it's not, call HR tomorrow morning. Then make sure that you're contributing at least enough to capture every dollar of it. You don't get much free money in life, so when it comes around, take it. Mistake number 3, choosing the wrong funds. Now this one can be a little trickier because it requires actually looking at what is inside your 401k plan. Most people find that about as fun as reading a terms and conditions agreement. But here's what you really need to know. Most 401k plans offer a target date fund, something like a 2045, 2060 retirement fund. And those can be fine as a starting point because they automatically shift you to be more conservative as you approach retirement and more aggressive the further you are away. There's nothing wrong with them, but you want to make sure that they stay optimized to your own goals. Sometimes they can be too conservative or too aggressive for you personally. Another big issue can be expense ratios. Every fund in this 401k is going to charge some kind of annual fee, and even small differences in those fees can add up to huge amounts over time. Some funds can charge 1%, some can charge 0.1, some can charge a lot more. And that might sound trivial, but over a 30-year career, that difference can cost you tens of thousands of dollars in growth. So look for low-cost index funds inside your plan. A lot of 401k plans will have them, and while they might not be sexy, maybe don't have impressive names, they can work very, very well. And also, this is another very big one. Don't put all your eggs in one basket, specifically being your company's stock. We've all heard the Enron story, Blockbuster, Kodak, companies that dominated for over a century, had employees who had their retirement tied up in their stock, watched it collapse almost entirely. If your company matches in company stock, that's fine, but think carefully about how much of your overall portfolio is tied to your employer. Your job and your retirement savings shouldn't be both vulnerable to the same company's fortunes. Mistake number 4, and this is one that happens to even pretty savvy investors, is never rebalancing your portfolio. Let me paint you a picture. In 2019, say you set up your 401k with a moderately aggressive allocation. Maybe you had 70% in growth-oriented funds, 30% in more conservative, stable ones. That probably felt right for where you were in life. But then the market had a great run. By 2021, without you doing anything, that balance could have shifted to 85% aggressive, 15% conservative, or maybe even more skewed than that. The problem is that your risk level just changed without you making a single decision. You're not taking on significantly more risk than you ever intended to, and you might not even know it. Rebalancing is just the process of bringing these things back in line. Sell a little bit of what's grown and buy a little bit of what hasn't. Most financial professionals recommend doing this at least once a year or whenever your allocation drifts more than 5 to 10% away from that target goal. Some plans might even have you be able to set up automatic rebalancing, which can be a great feature if yours has it. Set it and it handles itself. The goal here isn't really to maximize the returns as much. It's just to make sure that the risk you're carrying in your portfolio actually matches the risk that you intended to make. Now, mistake number 5, leaving old 401ks behind when you change jobs. The average American changes jobs 10 to 15 times over their career. It's a lot of potentially orphaned retirement accounts just floating out there. And look, we get it. When you're leaving a job, you've got a lot of things going on. The last thing on your mind is calling your old HR department to figure out, where is my old 401k? What do I do with my old 401k? So it probably sits there in some old plan with higher fees, fewer investment options, and you or nobody else is really paying attention to it. So you have options. The options you have, you can roll it in your new employer's plan, keep things consistent, or you can roll it into an IRA. Both can be good moves. An IRA in particular can give you a lot more flexibility and control over your investment options and what fees you pay. The bigger picture is this. Having your retirement account spread across 5 different accounts from 5 different employers, it's not a strategy. Just makes it hard to see your full picture, hard to rebalance, and you're probably paying more in fees than you need to. So if you've got old accounts out there, consolidating them all into one might be one of those tasks that sounds like it's a lot of work. It really might only take you an hour or two. And then that's something that can pay off for decades. And it's something that here at Hendricks Wealth, we're more than happy to help you walk through and even help you set them up. Mistake 6, trying to time the market. And this one is really tempting, which makes it so dangerous. The logic seems reasonable, right? The market looks shaky, so maybe I should pull out for a while and get back in when things calm down. Protect what I've built. But the problem is that it almost never works out that way. Markets can be really unpredictable in the short term, and the best days in the market tend to cluster right around the worst days. When you pull out during a panic, you almost always miss the recovery. Here's a sobering statistic. If you had missed just the 10 best trading days over the last 20 years, your total returns would have been cut almost in half. 10 days out of 5,000, almost 5,000. That's how punishing it is to be out of the market at the wrong moment. The research on this is overwhelming, and for long-term investors, which is what we all are inside of a 401k, time in the market beats timing the market. I feel like I've said that in almost every presentation I've given, regardless of the topic, but it's one of the most true statements, so I keep repeating it. The strategy that wins isn't the brilliant moves. It's staying invested through the volatility, continuing to contribute, and letting compounding interest do its thing. When the market drops 20%, your instinct is going to scream at you to do something. The right move, however, almost always just keep contributing. Think of it as you're buying at a discount. And our seventh and our final mistake, forgetting to update your beneficiaries. This one doesn't have a big dollar amount attached to it the way that some of the others might, but it can be one of the most emotionally expensive mistakes on this entire list. Here's something that can surprise a lot of people. Your beneficiary designation on your 401k actually overrides your will legally, completely. If your will says everything goes to your spouse, but your 401k still lists your college girlfriend from back in 2003 as the beneficiary, I think you can see where this can get complicated fast. Life changes fast. Divorce, remarrying, having kids, losing a parent. All of these are reasons to review your beneficiary designations. Most people haven't even looked at theirs since the day they enrolled. It's a 5-minute task. Log into your plan, find the beneficiary section, and make sure what's on file matches what you actually want to happen. Do the same for your life insurance, your IRA, any other accounts that you may have with a direct beneficiary, and then put a reminder to check it again once a major life event happens. It's one of those small administrative tasks that most people never do. And sometimes it can cause enormous grief for their families when they're gone. None of these things that we talked about today are really that complicated. None of them require you to be a financial expert. But all of them, if you do them consistently, can make a massive difference in what your retirement actually looks like. If you're not sure about where you stand in any of these, or if you'd like to sit down and take a full look at your retirement picture or your old 401ks, that's exactly what we're here for. Reach out to us at that email there, info@hendrickswealth.com, or feel free to give us a call on the number on your screen. We have offices in Illinois and Florida, and we're always happy to talk. So that is the end of everything I have. So open it up for Q&A here. I don't see that there was any questions, so give it 30 seconds or a minute. If anybody has questions, there should be a button down at the bottom of the screen. You can feel free to write one in. Looks like we don't have any, so in the meantime, take a look at our upcoming webinars. Next week, May 6th, we have Medicare 101 with Jim Hendricks and Joshua O'Brien. The following week, Missing Your Old 401k could be costing you more than you think with Jim Madel, which he will touch on some of these points I talked about today in a little bit more depth. And then the 20th of May, The Three Biggest Lies Keeping People from Getting Ahead Financially by Dan Leitner. If you're interested in any of these, go to hendrickswealth.com/events and sign up there. But regardless, thank you all so much for spending your time with us today. I really do appreciate it, and I hope you found some part of this useful. If you want to request any kind of appointment, either reach out to that info@hendrickswealth.com or either of our numbers. The Florida office, you will get me, and then the Illinois office, you will get anybody else. So thank you all again for attending, and I hope you all have a great rest of your day. Thank you.